What if I told you the biggest mistake in investing has nothing to do with picking the wrong stock? Seriously, people spend hours debating crypto, AI stocks, and the next Tesla, while drowning in credit card debt with insane interest rates, quietly destroying their future behind the scenes. It's like trying to sprint forward while someone is pulling you backward with a rope. No matter how hard you run, you barely move. I'm Alex, and I've spent years studying why some people build wealth effortlessly while others stay financially stuck no matter how much money they make. And the answer is surprisingly simple. Most people follow the wrong order. The truth? Building wealth is less about finding secret investments and more about mastering the sequence. Think about it. Would you install luxury marble floors in a house with no foundation? Of course not. Yet financially, people do this every single day. They buy stocks before building savings. They invest in crypto before paying off debt. They chase passive income while their finances are actively collapsing. And here's the scary part. One unexpected emergency can wipe everything out. Recent studies show millions of people couldn't handle even a small financial emergency without borrowing money. Imagine your car breaks down tomorrow, or you lose your job, or you get hit with a medical bill. What happens then? That's why step number 1 isn't investing, it's survival. Before you buy a single stock, build an emergency fund. Not because it's exciting. Honestly, it's boring. Nobody brags online about their emergency savings account. But boring is powerful. An emergency fund gives you options. It gives you breathing room. It stops life from turning every setback into a financial disaster. Start small. Your first $1,000 matters more than you think. Then aim for 1 month of expenses. Then 3. Build it piece by piece, instead of obsessing over some giant, impossible number. Once you've built that safety net, it's time to attack the real enemy. High interest debt. Credit card debt is brutal. If your card charges 20% interest, that means your money has to earn more than 20% just to break even. And almost nobody consistently beats that in the market. So while people dream about becoming investors, they're quietly losing guaranteed money every single month. Paying off high interest debt is basically a guaranteed return on investment, and guaranteed returns are rare. Here's the strategy. Pay minimums on all debts, then aggressively attack the one with the highest interest rate first. Simple, not glamorous, but incredibly effective. Now, here's where things get interesting. There's one exception to the pay off debt first rule. If your employer offers a retirement match, take it immediately. Why? Because that's free money. Imagine someone offers to double a portion of your paycheck just because you checked a box on a form. Would you say no? Of course not. Employer matching is one of the few guaranteed wins in finance. A 50% or 100% instant return destroys almost every other investment opportunity out there. After that, the game shifts from survival to optimization. This is where most people completely mess up. Instead of maximizing tax advantages, they rush into random investing apps and taxable accounts because it feels more exciting. But smart investors know taxes quietly eat enormous amounts of wealth over time. That's why retirement accounts matter so much. An IRA, for example, often gives you lower fees, better investment choices, and more control than many employer plans. And tiny fee differences? They look harmless until decades pass. A 1% annual fee might not sound scary today, but over 30 years, it can steal tens of thousands of dollars from your future. Then comes one of the most underrated financial tools ever created, the HSA. Most people barely understand it. Some ignore it completely. Huge mistake. And HSA gives you a triple tax advantage. Tax deductions going in, tax-free growth while invested, and tax-free withdrawals for medical expenses. That combination is ridiculously powerful. And considering healthcare costs in retirement can explode, having a dedicated, tax-free medical fund can completely change your financial future. Only after all of that do we finally arrive at what most people wanted from the beginning: regular investing accounts, stocks, ETFs, index funds, maybe even some carefully controlled speculation. But now you're investing from a position of strength instead of desperation. That changes everything. Because real wealth isn't built by gambling on trends. It's built through systems, step by step, brick by brick. The people who become financially free usually aren't the loudest. They're not chasing every headline or panic buying the latest hype investment. They simply follow the right order consistently while everyone else gets distracted. So if you remember one thing from this video, remember this: wealth is not built by speed. It's built by structure, and the people who master the structure eventually win the game. If this video changed the way you think about money, subscribe and join the channel for more real-world financial strategies.